if you budget out, the cost of hiring a couple salespeople, right? It's like, okay, we could argue what their comp should be, but let's say, maybe it's 100 or, 150, 200 grand a year for a really high caliber salesperson, right? That expense could go towards the purchase of a business that could come with those salespeople and also come with profits and revenue and all kinds of other stuff, right? And so why would you hire a sales team when you can buy a sales team potentially, right?
Hi, I'm Tom Shipley, CEO of Ava Agency Aggregator, serial entrepreneur, 18 acquisitions and exits, raised over 150 million in capital, and co-host of DealCon Agency and Brand CEO Summit. And what I'm really excited here, I get to be here with my friend and co-host to talk about programmatic M&A, Matt.
Tom, thank you so much. It's great to be here. For you, for those who don't know me, my name is Matt Bodnar. I'm the founder of Eidolon Capital. I've done more than $100 million worth of transactions, and I am the co-host of the DealCon M&A CEO Summit with my friend here, Tom. And we're really excited to talk about M&A, mergers and acquisitions, and how it can be super impactful for e-com business owners and agency owners. And I think those two spaces in particular are great spaces to look at acquisitions as a potential growth strategy. So I'm really excited to unpack a couple case studies and war stories and dig in and show how these strategies can really unlock a tremendous amount of value.
So for those of you who haven't done acquisitions, what we want to do is just open your imagination and just understanding that anyone, regardless of your financing, regardless of your situation, regardless of if you've ever done it before, can grow through acquisitions. And again, some people hear the term M&A and it sounds so Wall Streetish. All we're really talking about is growth through acquisitions. And what we found is that you can solve almost any problem your business is having through acquisitions. And I, as a guy who spent most of my life building brands from scratch and scaling them and was able to successfully sold over $2 billion worth of product from our brands. And what I learned is when my companies got into challenges and we hit a wall, there was an opportunistic acquisition that solved our biggest issue. And then looking back over my life, I realized that there is a process, and if there's a process to actually doing acquisition. And my goal for the last 5 years was just to create standard processes and demystify it.
So, Tom, I think it'd be really good to kind of jump in and hear a couple war stories or specific case studies of how M&A or how buying a business or an acquisition or merger can really unlock a lot of value for a business owner. I know you've had some really cool examples in both the brand and agency world. Is there a war story in particular or an example that jumps to mind for you?
Yeah, there's a really good one. My partner and I started Atlantico's brands, and we were creating a new model on how to build iconic beauty brands. And everyone said that these two former Special Forces guys are absolutely 100% going to fail. And with that, we both went financially all in, as we both said to our wives we would never do again. And we eked out that first year very proudly at a slight loss, $331,000 of revenue on our first brand, Hydroxytone. The problem was we ran out of money. Here we are, we leveraged everything. We had no more credit cards. We mortgaged our house. We even found a way to refinance our car so we can feed our family. Both of us had 2 young daughters. And so we were tapped out and we were done. And we happened to bring on a client to just generate some revenue, which was a $15 million business in Hoboken, New Jersey. They were great. They were 2 young entrepreneurs in their mid-20s. Or last 5 years, they built this business with 8 different products, and they had a CRM that they built back 2005. You had to build everything yourself. So they had their CRM. They had a programmer. They had a designer on staff. They did 10,000 packages a month of fulfillment out of the kitchen in this condo. So again, they had customer service, they had accounting. It was a really lean operation. They were doing 15 million in revenue and $1.5 million in EBITDA. And so we joked about buying them, but that joke turned into quickly a term sheet, which is a really amazing lesson. Is you never know what business is for sale unless you ask. And so we started with a joke and then started with well, we're either going to buy you or we're going to build you. Would you ever consider selling? And they said, as a matter of fact, and that opened the door. And so with that, but remember, we have no money, we're tapped out, but there's a profitable business. There is typically money out there, even if you have no contacts, on how you can get funding to acquire it. And that's what we did. We acquired 85% of their business at a 2 times EBITDA is what we pegged on that business. We negotiated it. It took us 4 months to put the capital in place and close that deal. But what's interesting is, remember I said the problem we had is with Hydroxon, our first brand, and 331,000 in sales is we were doing everything manually. We had no infrastructure. And while the economics worked great on that business from what our cost per customer acquisition is and our lifetime value, we couldn't figure out a way to scale it. But on this platform, within 3 years, that brand went from 331,000 in revenue, and Hydroxon went to over 100 million in revenue. We took that agency and grew that e-com store, Urban Nutrition. We grew it from 25 million to 35 million. But that's how we hit 135 million in revenue. Again, the acquisition solved channel, team, cash flow issue. It solved all of our issues. Otherwise, we would have been very, very challenged on how we could repeat that. And it broke all paradigms of what you need to have in order to do an acquisition.
So as somebody who had a product business, a brand doing a couple $100,000 of revenue, walk me through the process of how you guys said, hey, we're going to buy this bigger company. And how did you think about doing that deal?
Well, we don't. The whole thing is remember, you don't have to have everything solved at once. With every complex thing in business is you just need to think 2 steps ahead and solve one problem at a time. So the first was, can we negotiate a deal and get a letter of intent? We did that. The first thing we did a letter of intent. And as we started getting all the financials and reviewing it ourselves, we started using our network, and we said, who can help us raise the money? And our accountant said, I know a guy who specializes in mezzanine financing. And Matt, you want to share what mezzanine financing is?
Yeah. So, I mean, getting into some of the weeds here, but mezz financing is typically kind of like a bank loan, but, junior to it to some extent, which, it can be more expensive, but more flexible in a lot of ways, and can help sort of stretch the gap if you don't have enough capital potentially to get a deal closed.
Correct. And a lot of times they want a little bit of equity in the deal. Is it a little bit of an equity quick kicker? But it's better than raising the money and giving away the most equity in your business, which we did not want to do. So he went out, he put together a deck. He went out to a dozen different people, got 3 people that flew into Richmond, Virginia, where we were living, so we can give our pitch. We got 2 term sheets. We picked our favorite one based on who we thought would be the best long-term partner. And that was it. And then we went through their due diligence process, which was very thorough. And we acquired this business. Now, the question is why are they funding us? They funded us for 2 reasons. One is they said, Tom and Drew, you're highly capable, you're smart, and you have a great background. You're buying a business that has existing cash flow. Your business, we don't really care about because it's brand new. It doesn't mean anything. But you're buying a business with really strong cash flow, and that's what we're financing, and we believe in you because ultimately people will fund people they believe in.
So I think sorry, I didn't mean to interrupt you, but I think there's 2 really important lessons already that I see just coming out of that one quick example, which one is, as you kind of touched on, one of my favorite lessons is who, not how, right? So if you have a problem, instead of figuring out, how do I do this? How do I raise the money to buy this company? It's like you found a person, a who, that helped you solve it, right? And so when you're thinking about growing generally, I think that's a really powerful framework. But especially if you're looking at M&A, it's about finding the right guys, resources, advisors, people who can plug you into the right network so that you can then unlock the capital and the opportunity there. And the other thing you hit on that I also think is really key is this idea that even though your existing product or your brand, the business wasn't able to support the purchase of this new company as a whole, what it was able to support, the company on a standalone basis could still be financed, right? And this is a really cool concept that you can apply in a ton of different ways if you're thinking about buying businesses as an existing business owner, which is, as you said, you can buy a business on a standalone basis, even with no existing company. But if your company already has cash flow, assets, inventory, receivables, all kinds of different things, those can also go into the pool that could make the financing even better. So especially as an existing business owner, you can leverage a lot of those strategies to buy businesses without having to take on investors or having to massively dilute yourself on the capital table, or even, as in your case, without your company even being able to afford it, which I think is a really, really cool example of the power of this. And and tell me if you agree with this perspective, but I think it's also a really illustrative case study of the power of buying businesses, the power of acquisitions to say, hey, we had a product that was doing a couple hundred grand of revenue. We went and bought a bigger company that had the infrastructure to be able to plug our product into. And when you plug that product in, how long did it take you guys to get to 100 million in revenue? 3 years later, you have $100 million in revenue just from buying the right company and getting access, right? It's incredible. And if you had just spent those 3 years saying, how can we do this? And how can we solve this problem? We'll figure it out, inching your way, fighting, clawing to get to the finish line, you probably would have been like best case scenario in like $2 or $3 million of revenue, right?
Right. You're 100% correct. It is how you get asymmetric growth is the power of acquisition. As founders, as CEOs, as entrepreneurs, we have an obligation to look for leverage and look for, as we say in the military, basically force multipliers, things that give us an unfair advantage where we get a significant multiple return for whatever we're doing. And that's what acquisitions can do. And the thing is that if you remember from part of this is psychology, and this is fascinating, is that most people, their businesses get stuck at a certain level because mentally that's where they're comfortable and they can't break the paradigm of that. And so what acquisitions do is help you break that. And most people feel, well, I've never done an acquisition, and feel they have an imposter syndrome. Remember, here Drew and I were with this business where basically is we didn't have money to feed our family, and we actually had run out of all resources, and we went out and got a consulting gig so we can afford to have some cash flow to feed our family. And here we were telling them we have nothing, that we're going to buy their business, this $15 million revenue business. So it's interesting is you can live in your scarcity mindset, or you can live in abundance and look at the opportunities that are out there and just assume the identity of the person necessary to do the job.
So it's funny too, because I mean, that's an incredible success story, amazing case study of the magic that can happen through mergers and acquisitions. But you can also dial it all the way back to some really simple, basic blocking and tackling, right? I mean, I think back to, and these strategies are super applicable in both the agency and the e-commerce world. But I'll give you an example. The first company I ever bought was a small IT services business. It was doing about $1 million of revenue at the time that I purchased it. And one of the first acquisitions we ever did, similar to you, we kind of stumbled into it. I didn't have a strategy to say, hey, I'm going to go find some off-market deals and I'm going to grow via M&A. We basically bumbled our way into finding this data center business that was doing about $400,000 of revenue. And the owner of that business had another company that was doing really well. And he was thinking about shutting the data center down. And we ended up striking a deal with him where we said, hey, look, you're getting out of the business. We'll take it over and we'll pay you 10% of revenue for 3 years. And, we'll take this headache away, and, you'll get paid a little bit. And then whatever happens after that, great. Right. And so that on the total other end of the spectrum, you can also do a lot of these micro deals for that's a deal zero out of pocket. We didn't have to be some massive Wall Street, $15 million and figure out mezz financing and all that other stuff. It was literally a rev share buyout. We added $400K of revenue to our business by signing a piece of paper. And, our margins on that business were 15 or 20%. And so we paid the seller 10%. We're profiting from it day one. And on top of that, and this is what I think, just again, even at the very small ball level, we were able to cross-sell that product to our existing customer base and cross-sell it was an IT service. So we cross-sell our IT services to those data center customers, right? I mean, it's not rocket science, and it might seem intimidating to bite off a $15 million acquisition as your first go, though. I applaud you for doing that. I think it's amazing. But the reality is you don't have to do that. Even if you have a business that's doing $1 million or $2 million of revenue, you can buy a company that's doing a couple $100,000 of revenue in many, many cases for an earnout or for an acqui-hire or all kinds of different strategies. And I mean, no joke, literally today, I had an agency owner email me. Her agency is doing like $200,000 of revenue, and she wants to get out of the business, but she doesn't want to abandon her clients, and she wants to figure out a home for it. And she was actually reaching out to me, asking for me to introduce her to some agency owners who might want to buy her business as a rev share, basically. Right. So, I mean, and I've seen a half dozen deals like that just organically in my network in the last 6 months. But these opportunities are all around. And once you know how to programmatically look for them instead of just waiting for them to kind of stumble into your, into your net or into your world, you can really start to unlock some cool growth. And the math can be pretty cool. But so that just made me think. I just think it's really interesting that like you can do these epic mega deals where you go to $100 million, or if that seems scary and intimidating, you can start with little deals too. Either way, they can build a huge amount of enterprise value.
What's interesting I typically don't recommend that people do big deals. Typically, I say take your current business, divide by three. So keep typically a third of your business, and it's a good parameter for a tuck-in acquisition for you to do, and then be patient and make sure you're talking with enough people so you're buying the right acquisition. But that's typically bite size, and it's sizable enough that should not disrupt your business, but it's also big enough to have an impact on your business. So maybe we just talk a little bit about why should people do acquisitions?
I think these are good examples of why they should do it, right? But as you hit on, I think that rule of a third is a really good rough rule of thumb to say, hey, if you're just starting out, you don't want to get too far afield. A deal that's 30% or less of your enterprise size is a perfect starting place. So I actually want to share my screen really quickly and see if I can show. Let's see if I can make this happen. Just the math of a basic deal. And in this case, I've modeled up an agency. Um, and this is a great illustration of kind of what I'm talking about, of small ball M&A, where you're not having to go crazy. You're not having to do ridiculous, massive deals, but you can unlock a lot of value. So if you have a business that's doing $3 million of revenue, 25% margins, right? That's about $750K of EBITDA. I'm not making a statement here about the multiple. I think we could argue multiple could be lower, could be higher. 4x is kind of a reasonable multiple for a business of that size.
What is a multiple, and what does that imply?
Oh, yeah. So multiple is basically when you're buying businesses, in most cases, you'll buy them as a multiple of the earnings or the profit of the company. The fancy word you hear for that a lot of times is EBITDA, earnings before interest, taxes, depreciation, and amortization. But the easiest way to think about it is really just how much profit and, in a perfect world, how much cash flow does the business generate? And most businesses are valued or purchased off of a multiplier of that, right? So in this case, 750K of EBITDA times a 4x multiple, 750 times 4 is a $3 million valuation, right? So, and we can unpack in detail multiples and how to think about them, all this other stuff. But before we do, I think it's a really cool just illustration to say, hey, all right, if we have this little company, right? Let's buy a business. In this case, it's a third of the size of ours, which is, it's exactly what we were talking about. This other agency that's doing $1 million of revenue, it's a little smaller, so they're not quite as efficient, right? So they're only operating a 20% margin. They're making about $200K a year. And this is something you'll see across industries. You'll see it in the agency and the e-com brand world. The smaller a company is, the lower its multiple is. Conversely, the bigger a company is, the larger its multiple is. And so companies that are doing $5 million or $10 million a year of earnings will start to get into high single digit or even low double digit earnings multiples, which can really stack up to be huge valuations for these companies. But because this business is smaller, its multiple's a little bit lower. So in this case, I think a 3 times multiple is a pretty reasonable valuation for a company of this size. And so 200K of earnings times a 3x multiple is about a 600K valuation, right? So great. We found a single deal. It's about a third the size of our company. Let's buy it and see what happens, right? Now, what gets really interesting is I'm going to set aside the question of how we're funding this acquisition, because you can get super creative. We hinted at a couple of these things. You can raise external capital. You can get debt for it. You can use cash on the balance sheet. You can use the stock of the company as a merger. So you can do it with cash, without cash. You can use creative deal structures to do it, which is a whole other category of things like the data center acquisition I was talking about a minute ago, right? We bought a $400,000 a year business for $0 out of pocket just as a rev share. So we didn't put any cash out. But just for the sake of this, we'll assume we paid all cash for the 600K. What's really interesting is you take these businesses, 3 million plus 1 million, right? Merged company has 4 million in revenue. Pretty straightforward. EBITDA, 750 plus 200 equals 950. Same thing, just basic math. And that 24% margin is just achieved by dividing 950 or by 400, right? Or vice versa. The multiple now, because this business is approaching about $1 million of earnings, the multiple starts to creep up a little bit, not massively, but a 5x multiple for $1 million EBITDA or so agency is roughly market. Again, I'm not taking a stance on this, and we could debate whether it's high or low, but generally the bigger you get, and once you hit about $1 million, you're starting to push in that 5x range. And so this merged company, because it's a little bit bigger, trades at a little bit bigger of a multiple, is now worth about $4.75 million. Well, what's really interesting is if you take a $3 million business plus a $600K business, $3.6 million, just now because they've been combined together, they're worth $4.7 million. After the $600K has already been subtracted back out of this, that creates over $1 million of additional equity value, which is pretty wild, right? From a deal that's, not a massive, we're not talking about buying a $15 million company like Tom did. In this case, it's a pretty manageable, easy acquisition that could be relatively easily digested. But I think, after you've digested it, if there's a couple little opportunities to pick up some cost savings, right? Maybe there's a redundancy. Maybe you're not paying for you're not paying for accounting twice. You're not paying for the same HR software twice. You're not paying for the same project management. It's like all these little things that stack up, right? And so in this case, if there's a few efficiencies and we can pick up maybe $100,000 or $150,000 of total savings across $4 million in revenue, the value creation continues to stack up pretty massively, right? So if we take the business just by having a few operational synergies from about 950K of earnings to about $1.1 million of earnings, multiple doesn't change because it's still in that $1 million ballpark. That company's now worth $5.5 million, right? Which is, if we took a $3 million 600K business, 3.6 million, 550 minus that is almost $2 million of value created from a single merger of a business that's doing 200K in profit. That's a third of the size of the example company. Now that's great. That's awesome, right? Create $2 million of value, huge win. But what if you did that once a year, right? Like that's not a crazy thing to think about. Okay, you have plenty of time to digest it and integrate it and all this stuff. If you do that once a year, you're going to wake up in 2, 3, 4, 5 years with a company where if you're adding millions of dollars a year in value, that's going to stack up really fast, right? And suddenly you're doing 10 million of revenue, you're doing $3 or $4 million of EBITDA, and that business is starting to be worth, 20, $30 million. Really is a massive creation of enterprise value from not ever really biting off massive chunks and doing deals that are simple, easy, and digestible. So to me, this is just one illustration of getting a little bit into the math, but I think it really showcases the power that can be unlocked even from a single acquisition. But if you start doing this in a programmatic way, it can be even more powerful. And it doesn't have to be, though. You certainly can be ambitious and swing for the fences like Tom does. But you don't have to be doing a crazy $15 million deal. In this case, you need to figure out how to get 600K. That can be with stock, can be with structure, can be like the data center deal we talked about. There's lots of different ways to do it. But when you stack that together, suddenly it's creating millions of dollars of value, which I think is fascinating.
That was great. Thanks, Matt. And it's just changing people's mind as far as what is possible. And you're right. You don't have to figure out a way to do an acquisition and every other month. Is if you do one bite-sized acquisition a year, you're changing your destiny and the destiny of your family. And what's really interesting is that I consider, I hope this doesn't offend anyone, but I look at my years of building brands from scratch and then scaling them, whether to 5 million, 10, 50, or 100 million. I look at it as if painful, not always successful. Many hit the cap along the way. So you hear the home run stories or the great stories, but what you don't hear is I haven't taken you through the graveyard. And what you find is that along the way, I was dragged through a lot of asphalt and glass. And that's what organic growth can be. It is not guaranteed. It is rough, and it's a lot of hard work. And again, you say, okay, we're going to hire a sales team. Well, there's risk to hiring a sales team. There's, as you're doing that, and we're going to open up a brand new channel, brand new division, and we're going to hire people in, and we're going to figure this out. Again, it doesn't guarantee you that 20 or 30% growth. If you're very thoughtful about acquisitions, it's a very structured way of giving growth and potentially giving you. Why hire individual salespeople when you can buy a company that has a sales team?
Yeah, and I've seen. I don't have an example to pull up the ROI on it, but I've seen just anecdotally some really cool stories of that exact thesis, which is like if you budget out, the cost of hiring a couple salespeople, right? It's like, okay, we could argue what their comp should be, but let's say, maybe it's 100 or, 150, 200 grand a year for a really high caliber salesperson, right? That expense could go towards the purchase of a business that could come with those salespeople and also come with profits and revenue and, all kinds of other stuff, right? And so why would you hire a sales team when you can buy a sales team potentially, right?
And on another episode or session, I like to dig in and share some stories of what I've helped people do and people in my network have done and what I've done in order to basically use acqui-hire as a model to buy EBITDA. At the same time, I'm solving an issue of hiring one or more or a group of people to fulfill the services.
I've got a couple case studies too on some fun acqui-hire deals that we've done. And, I think hopefully this is given you a taste of the power of mergers and acquisitions. And we'll get into this in a later video as well. But I really truly believe that both the agency sector and the e-com sector are some of the best places to be playing from an M&A standpoint for a variety of reasons, which we'll talk about in an upcoming video. But hopefully this has given you a sense of the power of M&A. And we'll see you back on our next video for a couple other case studies, war stories, and examples. And we'll talk about why these sectors are uniquely positioned to be really, really powerful places to play from a mergers and acquisitions standpoint.
One thing you don't want to miss, and this is something that Matt and I want to share with you, is he mentioned it's not the how, it's knowing the who. That can give you the frameworks that can basically compress. As CEO, as founders, as entrepreneur, we have a responsibility to find the leverage and to basically figure out a way to create that asymmetric growth and profit opportunities. Acquisition is it, but it's learning. So I'd like to invite you to our CEO M&A conference. We're limiting it to 100. We capped out last time. We're limiting it to 100 agency and brand CEOs in Nashville from the 23rd to the 25th of September. It was a spectacular event in February. The next event we're having, September 23rd through 25th, is great. If you want to find out more information, go to dealconlive.com. Dealcon, short for Deal Conference, live.com.
And as Tom said, if you want to get 3 days worth of this kind of stuff and apply it directly to your business with tons of experts and other top level business owners, come to DealCon. It's going to be amazing. It's going to be a lot of fun. And we really hope to see you there.
Thanks, Matt.
Thank you, Tom.